Hey everyone, and welcome back to the video. In today's video, we're going to be having a look at part 2 of that full stock analysis presentation of Thor Industries. Now again, if you didn't see part 1, this is a presentation that's from my private investing and community and platform called Learn by Example. And Learn by Example is essentially a platform and community that helps investors to consistently find low risk, high return investments by providing consistent examples of detailed stock analysis in report form and in presentation form. And we have our private community where we have weekly live streams and you can have discussions with me in there. And the reason that I developed this is because I think that you've probably noticed there are a ton of investing books and online courses out there that teach these principles, these value investing principles, but there's no one really teaching and helping people to apply it in their own time. So I developed essentially the teacher to the textbook. I consider a lot of these books and online courses to be a textbook, and a lot of people buy a textbook and they have no idea what the hell to do with it. So I am providing the teacher so that you can ask ongoing questions, unique questions as they arise, and you can look at my example presentations and reports so that you can learn how to actually apply these principles rather than not knowing how to apply them or applying them in the wrong way. So of course, if you are interested in becoming a serious investor, then click the first link in the description below and it will take you to a free 20-minute video which tells you my exact process that I use to consistently outperform the market, essentially giving you the textbook for free. And then if you want to learn more, you can apply for a call with me and we will work out if you will be a good fit for our private community. But with that said, enjoy part 2 of the presentation and I will see you in the next video. So that brings us to the second part, which we look at, which is economic moat. And essentially, just a brief thing of what an economic moat is. So an economic moat is a long-term competitive advantage that a company has over its competition. And really, the reason it's called a moat is it's an analogy. And essentially, you can imagine that there's a castle with a wide and deep moat around it. So like an old medieval castle with a moat with water in it, and it's got alligators in it or whatever. And that moat protects itself from invasion for longer than castles that don't have that moat, that don't have intrinsic layers of protection. And that's the comparison we make between a castle and its moat, and also a castle with no moat that can easily be attacked by its competition, and a company with a moat and a company without a moat. And really, we need to assess these moats in a qualitative and a quantitative sense. And we can only really be effective at identifying these characteristics if we're a person who has a deep understanding of the industry in which a business operates. So you need to be able to fully understand the industry and the business in order to do this kind of analysis. So the first thing we want to do is we need to quantitatively analyze the company. We do this by looking at the business and its competitors to see if we can just look at the company and see if we can identify any powerful intrinsic characteristics. And after we do that, we want to do a quantitative analysis to see if the business's past performance confirms our hypothesis that there is an economic moat. And essentially, we do that by looking at the company's fundamentals. So the qualitative moat that I think Thor Industries has is an economies of scale. So Thor Industries has 50% market share, and that is half of the industry's cash flow. And what that basically means is that they can quickly and cheaply increase the production when demand for RVs is high, and they can also do the exact opposite. As we mentioned earlier, they can quickly and cheaply reduce production in a recession when demand is low. And they can do this because they have half the industry's cash flow. Now, smaller companies can't do this at a low cost or quickly because they don't have the economies of scale, which is where it's cheaper in order to do things like that because you're a massive company. So essentially, when demand is unexpectedly high, dealerships will be short on inventory because people have been buying them. And essentially that means that they're going to need to order more from manufacturers. Now, Thor Industries can take more orders quickly by increasing its production. So just quickly, it buys out some leases, it increases its production, and it takes those orders. Smaller companies, however, they have to refuse these increased orders because they don't have the money to invest in increasing their capacity. And this is a huge competitive advantage that Thor Industries has over smaller companies. And it means that dealerships will consistently go to Thor Industries when there is excess demand because they know that they can do it. They know that they can increase their capacity and provide the orders that they need. However, this is just a hypothesis. This is just an opinion based on my analysis of the business. So we also need to look at the numbers and do a quantitative analysis. And if we look at their growth numbers, they have been exceptional. These are some of the best numbers I've ever seen in a company because they have consistently been able to maintain their acquisition strategy and also effectively increase their demand and decrease their capacity, increase their capacity and decrease their capacity when it is necessary. So the reason that I'm looking over 13 years here is because I wanted to include the peaks before the GFC. Because if we just look at the 9-year average, that is basically looking at the growth from the bottom of the recession until now. And that's not an accurate representation of the company because it's just the upward bit. It doesn't include any of the down. It doesn't include any of the negative times that happen when they go into a recession. And that's warping their results, which it looks like they're growing at 20% sales per year and 44% EPS per year, which is not how they're actually growing. So if we look over 13 years, we're looking at from 2005 until 2018. And we can see that their growth has still been exceptional. Almost 10% growth in sales, 11% growth in earnings per share in profit, almost 10% growth in equity, and 11% growth in free cash flow, which is just exceptional. And it tells us that they do have a competitive advantage because they're consistently becoming more and more profitable. And this basically leads me to the conclusion that Thor Industries does have an economic moat, and it is providing the business an advantage over time. So essentially, the qualitative characteristics of the moat are likely spread across multiple dimensions. So economies of scale would be one that I can identify, but there would be other ones that I just haven't identified. That's the nature of a qualitative analysis. You're just looking at the business. It's pretty subjective. There's no, oh, you're right or you're wrong. It's usually that the moat is a number of different things that add up together, a number of different layers around the castle that add up together. And I've identified that economies of scale is one of the big ones, but there's probably other ones. And ultimately, we do a quantitative analysis and we can see that they do have a moat because we look at their numbers and we can see that they've had strong industry performance. And the key part of this is that even if we include before the GFC, so including the fact that they lost, what did they lose? They lost revenue of 50% in 3 years. Their long-term revenue growth, including that decline, has still been 9%. So they're growing at a really, really high rate, even if we include the years where they perform really poorly. So that brings us to management. And essentially, when we invest in a business, we are allowing a team of executives to make capital allocation and investment decisions on the behalf of our company. So the effectiveness of management's investments and other business decisions will impact the amount of cash that will be returned to us over time. And the amount of cash that is returned to us is pretty much all we care about because we're trying to put our money, invest in a company and bring back more money. We want the amount of cash that's going to be returned to us. We want that to be the maximum possible amount of cash. And for that reason, we need to assess management under two lenses: their integrity to the shareholders and their competence as decision makers. And really, in assessing the viability of an investment, we need to know about risks and challenges as they arise, and that is basically dependent on the transparent communication of management. So management needs to have integrity. They need to be telling us about problems so that we can assess them and we can work out whether or not the company is still a good investment. And then, of course, we need to look at the numbers and we need to maximize the cash flow that we're going to receive. And that means that we need management to be making, very, very high rates of return on capital and also managing debt in a way that it's not going to come back and destroy the company at some time in the future. So to assess management's integrity, I usually start by looking at who these people are and what are their interests? Are they aligned with ours? So we've got the two founders which founded the company in 1980, and that's Wade Thompson. Unfortunately, he passed away in 2011, so he's no longer with the company. However, the other founder, Peter Orthwain, has been a director since 1980. He was the CEO and chairman from 2009 to 2013, so he did that miraculous work of pulling them out of that recession. And he's currently the executive chairman of the board. And one other thing I've got here is that he owns approximately 2 million shares, which is almost 4% of the company. So his interests are very much aligned with the shareholders. For one, he's a massive shareholder, so the long-term profitability of the company is going to directly impact a massive part of his net worth and his money. And the other thing is that he's the founder, so it's his baby. He made this company. He wants to see it become as successful as possible over the long term, more than anybody else. We then have the CEO, which is Robert Martin, and Robert Martin is also the president, and he's been at the company since 2001. And he holds about 5 million in shares. So that's less than 1% of the company, but he still has a significant amount of money in the company, which again means that his interests would be aligned with the companies and with the shareholders. So some other things to mention that are in the policy of this company that allow management to have interests that are aligned with the shareholders. So the CEO is required to hold 5 times his base salary in stock, and that's basically just a long-term incentive. And the rest of the board of directors need to have 3 times their base annual retainer in stock. So all of the board have to hold stock and a significant amount of stock so that their interests are long-term and they want to see the company succeed long-term. In 2018, no stock options were awarded as compensation, although they do have a stock options program. Now, a stock options program is something that Warren Buffett doesn't like. It's what Phil Town doesn't like because it can incentivize short-term incentives. It can make management do things that make the stock price go up quickly so that they make money quickly. However, in Thor's case, the program is restricted to stock options with an exercise price of at least 100% of fair value, and that's aimed to incentivize long-term growth in the stock price. And as I just said, these programs are not desirable by shareholders because if these shares are exercised, it means that it's going to add more shares to the pool of shares. So your one share is going to become a smaller piece of the pie after these new shares have been gifted to these CEOs and board of directors. So then we need to look at capital investment, and essentially Thor Industries has maintained a really high return on invested capital. So that's basically how much money they make on the money that they're investing. So they make an investment decision and that brings in more money and we need to work out what return that is. And essentially most of the time, Thor's return on investments is increasing year to year. As you can see from the graph, it's increasing almost every year, except for when there's poor economic conditions. So we can see between 2008 and 2010, there was a significant decline in the profitability. However, they recovered quite well, and since 2014, it's been above or close to above 20%, which is a really, really high return on invested capital. It means that they're investing very, very effectively and that they only have to invest a little bit on each. So every dollar that they invest, the extra dollar they invest, they're going to produce even more profit than the previous dollar. So they invest $1, maybe it brings them back $1.10. The next dollar that they're investing, they're bringing back $1.11. So that's what that upward trend on that graph shows. It shows that they're becoming more effective over time. And a 20% ROIC is very, very high. Then we need to look at debt management. So do they have too much debt on their plate and how have they been managing that? So as of October 31, 2018, which is the latest report, Thor Industries had current assets of about 1.3 billion and current liabilities of about 800 million. And that gives them a current ratio of 1.66. So ideally, we're looking for a company that has a current ratio of 2 or above. And this basically ensures that they have enough short-term assets in order to cover their short-term obligations. So Thor falls just short of that. And that's something we definitely want to be watching going into the future. The other area that we look at for debt is total liabilities versus equity. So Thor had total liabilities of about 870 million, and they had equity of just under 2 billion, and that gives them a debt to equity ratio of 0.45. Now, ideally, a company should have a debt to equity ratio that's below 0.5, and Thor Industries is below 0.5, so that's excellent. That is exactly what we like to see. However, that total liabilities number does not take into account the debt that they're taking on due to the Erwin-Hymer acquisition, which is quite a large amount of debt. So this, I've written here that it's expected to close at the end of 2018. It just closed at the end of January 2019. So it will be on their books either in the second quarter or the third quarter of 2019. So just to get specific about this debt, it was financed through JP Morgan and Barclays, and it was two separate loans. The first loan is a term loan that lasts for 7 years, and it's 2.3 billion. And the second loan is a senior secured asset-based loan that's 5 years, and that's 750 million. So it's not super long-term debt, 5 to 7 years. However, that will impact their current ratio and their debt to equity ratio. And we really won't know to the extent that it will be impacted until those financial statements are released. So when they're released, we can talk about it, but until then, we just know that this debt is going to probably make both of these ratios unfavorable. It'll probably mean that it'll fail to meet our requirements for both of these ratios. However, just to bring it back to the positive, Thor's management has been very good at paying down debt. I'll give you an example. In 2016, Thor took on 320 million in long-term debt to fund the acquisition of THO. And the CEO basically said at the time that it was his intention to retire that debt quickly, and within 1 year he'd paid down 75% of it, and within 2 years it was completely gone. So he quickly got rid of the debt because he also doesn't like debt. However, that's 320 million compared to the 3 billion that they just took on through the Erwin-Hymer acquisition. So that brings us to the final component of our analysis presentation here, and that is, of course, intrinsic value. So essentially what we're trying to do here is we're trying to only invest when the price of an investment is far below its intrinsic value. Far below its intrinsic value. And intrinsic value, defined by Warren Buffett and how I'm using it here, is the total amount of cash that can be taken out of a business over its remaining life, discounted at an appropriate rate. So since we don't know how a business is going to perform in the future, we can only come to an estimation of what a company is worth. There's no definitive intrinsic value number. We can only estimate because the intrinsic value is how much cash they will bring in the future. So we can never find out exactly how much they're going to produce. However, to avoid overestimation and poor investment decisions, we err on the side of conservatism when making cash flow estimations. And we also come to a range in which intrinsic value will likely fall rather than concluding a single specific value. Another thing we do to err on the side of conservatism is that we only make investments when the price of an asset is far below its intrinsic value. So we only invest when we have a significant margin of safety, and that ensures that even if intrinsic value is poorly estimated, we will still make a satisfactory return, and at the least we won't lose money. Now, future cash flow is very difficult to estimate, but it is easier in companies like Thor Industries. And that's basically because their earnings are stable and consistent. So they're not stable in the cyclicality. So they do have earnings that decline dramatically at the end of an economic cycle when we have a recession, and they bounce up massively when economic conditions are good. But they are consistent. So if we looked over time, we could see that equity growth over the long term was very consistently going up and up and up. And their growth in cash flow has been very consistent. And that means that if we look beyond one cycle, so if we're not trying to predict what's going to happen in the next 2 years or the next 1 year, if we just look 10 years out, we can be fairly accurate in measuring how much cash this company can produce if we're being conservative. So from 2007 to 2009, Thor's free cash flow declined 80.5%. 80.5%. So investors need to anticipate that if you're investing in this company, there is going to be negative growth in cash during an economic downturn, which we're probably on the fringe of at this current time. Probably within the next 5 years, it's very likely. So that's something you need to be aware of. This company is going to go down before it goes up. However, if we look from 2007 to 2018, which is the current bull market, peak to peak, so from the very heights of their free cash flow to the highs now, their free cash flow has grown at 3.71%, and that's basically around the RV industry market growth, which was 4.3%. So if we just assume that Thor can maintain its market share, then it at the very least should be able to achieve somewhere between 3 to 4% growth in free cash flow. So that's a very conservative estimation of how they can grow their cash. If we then look at 1998 to 2007, which is the previous bull market before the GFC, from peak to peak again, free cash flow actually grew at 21.55%. So essentially, to calculate how much cash Thor produced for its owners, because that's what we need to calculate, we're not using free cash flow, we need to calculate how much is going to be returned to us. So essentially, we need to calculate the 2018 number, and I did this by getting the operating cash flow, which was 466.51 million, and I subtracted the capital expenditure that was used to replace machinery and equipment that was used in the ordinary course of business. So this is just to maintain the business, and that gives us a cash flow for owners of 426 million. Also, what I did was I calculated the 9-year average cash flow for owners to be 201 million, and that's going to be for our very conservative no growth component of the model. So let's have a look at the models. Now, I used a discount rate of 3%, so that is the current 10-year treasury yield. So if you just want to not risk your money at all, you just want a 100% safe investment, then you can go to the US Treasury and invest your money for 10 years at 3% per year. So what that means is that it's going to tell us, if we discount the cash that Thor returns to us at 3%, it's going to tell us how much cash we can get out of this company, taking into account the relative opportunity cost of not investing in a 10-year treasury yield. So this is what intrinsic value is telling us, how much cash we think we can get back based on the different growth rates and the starting cash flow. So essentially, if we look at model 1, if we anticipate that every single year for the next 10 years, that Thor Industries returns to us 201 million in cash, these are all in millions, then the intrinsic value is 1.7 billion. Model 2 tells us that, again, if they didn't grow cash, but they maintained their current cash flow level, which was 426 million, that was the 2018 number, then the intrinsic value, or the amount of cash that can be returned to us, would be 3.6 billion. Then we get into the growth components, which is we have that 3.71, which was their growth from peak to peak in the last recession. That would give us cash back of 4.4 billion. I've got 10% there, which has been their equity growth rate for the past 13 years. That would give us 6.2 billion. And then I've got that the growth rate of cash from the recession before the GFC, that was 21.55% growth. That would give us cash back of 12 billion. And essentially what that means is that we can calculate that Thor's intrinsic value falls somewhere between 1.7 and $12 billion. And that's a big range because we've got a wide variety of options here. However, I've done that because I want you to do your own research into this company and work out which model you think is most effective. Personally, I would err on the side of models. I wouldn't use model 5 in my estimations unless I was using a significant margin of safety. Model 3, I would say, has a very high likelihood of happening just because of how quickly the RV market itself is growing and the fact that Thor is still growing within that industry and it's probably the best business in that industry. So I would say that 4.4 billion of intrinsic value of cash back from this company is very realistic at the very least. And I also think that model 4 isn't too unrealistic. And I think if you're using models 1 and 2, then you're being very, very, very conservative. And I would be highly surprised if Thor Industries didn't produce that amount of cash. So then what we can do is we can remodel these, but instead use a discount rate of 26%, which is 10 times our money over 10 years. And we can use that to calculate how much we would be willing to pay in order to make 10 times our money over the next 10 years. So the models are entirely the same, but instead of giving us intrinsic value, we now get a buy price. So using model 1, we get a buy price of 700 million for the entire business. That's a market cap number. It goes up to 1.5 billion, then 1.7 billion, then 2.1 billion, and 3.5 billion. Now, at the time of writing this, Thor Industries has a market capitalization of 3.45 billion. So that means that this would be a good investment at the current price, only under model 5 and assuming that you're targeting a 26% return. So if you're targeting a smaller return, then it could be a buy under different models. However, I always target 26% because what that does is it gives us at least a 15% return plus a 50% margin of safety on that 15% return. So even if they perform really poorly, we'll probably still beat the market, and we will most definitely not take a loss on this investment over a 10-year period unless the company goes bankrupt. In my opinion, models 1 to 3 are the safest and most likely outcomes. So what I'm saying there basically is that if Thor Industries' price for the whole business fell below 1.7 billion, I would be very, very confident in making a significant return over the next 10 years. I'll just say that. But it's up to you. You need to do your further research and work out which of these growth rates is most likely to occur. And based on your knowledge of the industry and the business, you can make your decision as to whether or not you're going to wait for it to become very low, because it might never fall that low if you be very, very, very conservative. But if it does, you can just be conservative and wait. You might not get it this cycle, but you might get it the next cycle. But if you're confident that this company can grow faster, then you might be willing to pay a little bit more. And under Model 5, you would be willing to buy it at the current stock price. So that's all for this presentation of Thor Industries. I hope you learnt a thing or two about Thor Industries and can determine whether or not this is a company that you want to go and do further research into and potentially make an investment sometime in the future, or even now, depending on how much research you've done into the company thus far. So I hope you guys enjoyed this one, and I will see you in the next presentation.